Good afternoon, everyone. Today is the fourth day in July 2021, and today we'll be discussing on intangible assets and goodwill. And all of our discussions will be in tandem with the requirements of IAS 38. IAS 38 talks about intangible assets in which goodwill is a component of. And we're going to see why goodwill, other than other intangible assets, is so unique that has its own peculiarities. And again, further to discussions we've had under Ifrs 3 and Ifrs 10 in the process of accounting for business combination and in the process of consolidating the account of a group, we emphasize much more on goodwill. And then we made reference much more to the requirement of IAS 38 in its recognition. And that will more or less give us some credence in what we'll be discussing today with respect to that. Okay, and looking at this, it will interest you that our discussion may take one or two other dimensions where we'll be discussing with respect to football clubs, and our discussion about football clubs will also more or less give us leverage about understanding similar clubs or organizations in that light. Because this question do arise at most gathering or occasion where people ask, players that were signed off, how do you account for them in the books? Will you now be accounting for human resources in your books? What value do you place on human? And therefore, if you could place value on human, what about me working in an organization? What is my value in the balance sheet of my organization? Today we'll demonstrate it is the value of the woman in trying to draw organization that will be recorded. It's what we always discuss situation has its own peculiarities with respect to identity. And the floor is now open for someone to make a Okay, thank you guys. I believe you can hear me better now. Okay, my question is this. I asked you guys to more or less make contribution about your expectation or your concern with respect to how you account for intangible assets and goodwill in the books of an entity. And that will more or less give us more or less is going to provide us guidance towards what we're going to discuss in this session. Over to you guys.
Thank you very much, Mr. Muiwa. The standard we are treating today, IAS 38 Intangible Assets, is a very vital standard, especially considering new business models that are evolving. You know, a lot of companies now uses software as a service, platform as a service, and you know these are based on software platforms that's that forms the basis of the organization's business. So that means that most organization goodwill is now intangible asset is now becoming a very important item of the financial statement, which needs to be studied critically and understood. So that is why I am very, very curious to know more about what the standard says today. Though it's not as if I'm coming with zero knowledge, but yet I know that, with this kind of program, there will always be one or two other takeaways to add to what I already know. So, since I've been around here, I've had opportunity to work with organizations that uses software as a service. That means that the knowledge I'm going to acquire today will be beneficial to this kind of organizations going forward. So thank you very much. I'm looking forward.
Thank you. Another.
Okay, good afternoon, everybody. Yeah, as the topic is concerned, intangible assets and goodwill, as IAS 38. Honestly, it's not a new concept, but unfortunately, I've not been opportune to apply IAS 38 in practice, and my expectation is to know how to apply IAS 38 and the provision of the standard as the IAS 38 is concerned. Thank you.
Okay, good afternoon, everyone. For that is accounting for goodwill and intangible asset. I think I've not actually used it that much, apart from when we treated it under business combination, and we considered purchase goodwill. But beyond that, I've not used it, but I'm really looking forward to learn a lot about it today, especially being the way that Mr. Moya started the class, I think we want to talk about how clubs account for players signing fees and contracts, and they are actually part of which are regarded as intangible assets. That is an aspect of accounting that I don't actually know. I don't actually know anything about it actually. That aspect of accounting, which I think I would want to know about how clubs account for their players and how their accounting is done vis-a-vis IAS 38, and also want to learn. I will look forward to learn more about that this standard, because it was standard that I know next to nothing about, apart from the business combination aspect.
Thank you very much. Okay, that now, and we'll move. Okay, now what we need to understand about this standard itself, we need to see the scope of that standard. That what does it bring to the, is that the standard by nature in place, and what does the standard tends to achieve? One of those things that's basic to the standard is that it assists us to establish criteria that we'll use to identify whether a set of activities constitute an intangible asset, and can such be recognized, or should it be recognized? Likewise, we also look at it from the perspective where we need to look at how intangible asset is to be measured. And lastly, to look at various disclosure requirements with respect to activities revolving around intangible assets. Okay, now, which means when you look at all what I've discussed, it speaks to the RMD principle of financial reporting. The R stands for recognition principle, the M stands for measurement principle, and the D stands for disclosure principle. Now, when we look at the requirement of IAS 38, the objective of IAS 38 primarily is to prescribe the appropriate accounting treatment for intangible assets that are not dealt with specifically in other standards. You find out today that there are some intangible assets that are specifically dealt with in other standards, and we're going to look at that. But for all other intangible assets that are not taken care of by another standard peculiar to it, will be considered within the respect of IAS 38. Okay, and the standard requires us to recognize an intangible asset if and only if specified criteria are met. Now today we'll look at the criteria required, and upon that we'll now look at how do we recognize such an intangible asset, how do we measure it at the point of recognition, that is initial recognition, and subsequently, how do we recognize or measure it in order to obtain the carrying amount? And finally, we'll be looking at the various disclosure requirements. Okay, in essence, I would say that the objective of the standards can be identified in three perspectives, or can be categorized in three perspectives. As I've said earlier, the perspective include recognition, followed by measurement, and followed by disclosure requirements. Now, in summary, let me present it for us for record purposes. Okay, any question at this point? Because the next thing we are going to look at is the scope requirement of the standard. The standard covers intangible assets, except those that are scoped out of it. And there are four aspects of it that is scoped out, which we are going to look at with respect to the standard. Okay, for example, when you get to intangible assets with respect to mineral resources, which we call expenditure that involves exploration and evaluation of assets, or what we call the mineral resources. This is scoped out of the requirement of the standard. Likewise, we have other aspects with respect to financial instruments and the likes. Okay, let's look at the scope of the standard. Now, this standard applies to virtually all intangible assets except for the identified ones. One, intangible assets that are within the scope of another standard will never be taken into consideration in our discussion. And likewise, financial assets is more or less taken care of under IAS 32. Okay, and we also would have considered the requirement of Ifrs 6 with respect to exploration for and evaluation of mineral resources. And lastly, expenditure on the development and extraction of minerals, oil, natural gas, and similar with genetic resources are outside the scope of IAS 38, or because they are more or less to be addressed by other specific standard convention or the conceptual framework. And therefore, you must take note that not necessarily all intangible assets are within the scope of this standard. Now, the next thing we need to understand is the criteria that is required in line with the standard. What are the criteria that need to be followed with respect to the requirement of the standard? Now, there are three criteria that we will be looking at in our discussion, okay? And the first one will be issue of identification, okay? Now, let me bring it forward. Now, the first criterion is identification. That is, it must be identifiable. The second one is that there must be control. And what that control speaks to is it must be controlled by the entity. The top criterion is future expectation of economic benefits. Therefore, these are the three attributes that you need to look for in the course of identifying what an intangible asset is and recognizing such. Now, before we go into the deep discussion about the criteria, what we need to ask ourselves is, what is an intangible asset in its real sense? Now, I'll put this to us so that we'll more or less put down our thoughts before we make elaborate deliberation discussion on what an intangible asset is. Now, over to you guys. Who will lead us in this discussion? What do you perceive to be an intangible asset? What is an intangible asset? Over to you guys.
Okay, thank you very much. Based on these criteria that you've highlighted, we can say intangible assets are identifiable assets, under the control of an entity. They are assets that doesn't really have a physical form, but we generate future benefits, future economic benefits for the organization. So just putting these three together and adding the fact that they don't have physical form to it. So that is just my way of defining an intangible asset.
Okay, who else? Ross. Mr. Nuruddin, what's your own perspective?
I actually share the same view with what Shogun just explained, that intangible assets are the identifiable assets that can not be seen, that can not necessarily be seen physically, but generate economic benefits to the entity. That's the view I have as intangible asset as concerned as well.
Mr. Nauru, I want your thoughts.
I think that's it, that any asset that is identifiable within the control of the entity that is expected to generate economic benefit to the organization for more than a year, should be recognized as an intangible asset. It doesn't have any physical presence. So that is where I see it.
Okay, from your own perspective, you have limited it to just any form of assets. Okay, but you need to be wary of what you say with respect to intangible. Okay, I think I can break it down into two. Intangible assets by nature are non-monetary assets. They are non-monetary assets. That's the first thing you need to take note of it, by nature or characteristic. Another characteristic of an intangible asset is that such an asset has no physical substance. And when we say an asset has no physical substance, what are we talking about? We are talking about the perspective where it's an asset that you cannot touch. You cannot necessarily see in its real sense, but it's something you can feel, or because it contributes economic benefits. And it engineers other physical assets in order to actualize the value associated with it. And therefore, the standard reached a conclusion to define an intangible asset as identifiable non-monetary asset without physical substance. And this asset must be controlled by the entity as a result of event that has happened in the past, which we characterize as past event. Furthermore, something from which the entity expects future economic benefits. And this is where I draw up the three criteria as identified earlier above. That one, an intangible asset must be identifiable as an asset, which is what we have here. Two, an intangible asset must be controlled by an entity, which is what I have here. And three, an intangible asset must be capable of bringing forth future economic benefit, which flows to the entity. And that's what we have here. And that is our position with respect to intangible assets. Now, if we have this at heart, and we believe we have understanding of it, let's look around us and try to identify any form of intangible assets that an organization, whether our organization or any other organization we know, or from what we've been exposed to in time past, who will give us example of an intangible asset.
So we can start from Goodwill.
Examples of an intangible asset. Okay. Over to you.
Yeah, we have purchased goodwill arising from business combination.
Okay. Another person? Another person?
We have
Things like innovations, patents.
Patents.
copyrights.
Innovation is not innovation is just an act or action. But what comes out of innovation can be patented. Therefore, patent, okay?
Copyrights.
Copyrights, yeah.
We have customer lists.
Okay. What is a customer list? When you say customer list, what do you mean by customer
We
list?
have franchise.
I said, what is customer list in principle? Because I do hear it a lot. Customer list. Who can give us guidance? What is a customer list?
I think customer lists can be interpreted as those loyal customers that an entity was able to maintain over time.
Okay, let's look at it from this perspective. Why is it that if a company wants to set up in Nigeria, why can't the company just come? For example, an insurance company comes to Nigeria and it just starts its insurance company and say ABC Insurance Company. Why do they prefer to even get any insurance company as little as they have or as small as they have, whether they are struggling or not, just to have an existing insurance company which you will buy over and use it to, you restructure it internally for the purpose of unveiling ABC Insurance Limited? Why do such happen? I want to relate that to customer list. Who can tell me why?
Well, I think that may be because the insurance company, for instance, already has built a brand, a recognizable brand that is well known. You don't need to spend so much money on marketing to get it, to make it known. So basically, that inherent, that brand or no, that recognition is an asset in its own right, which the foreign company wants to tap into and expand or use as a vehicle to expand even further.
Okay, to some extent, I've also put a question mark there where I said, what about if it's an insurance company that has started to lose its reputation, is struggling, and a new company, a well-known insurance company abroad is coming in to even take over it? Why can't that company come to set up its own from scratch so that there's nothing tainting it? But why is it going for even a struggling insurance company?
Okay, for me, that if for you to go for a strong insurance company, because even though the insurance company is struggling, it has a structure, a name already. It has customers that are subscribing to the premium. Pardon?
The name doesn't matter because the name is no longer worth it in the market.
Basically, but it actually using the structure of the well-established structure, branches that are spread over the country. Also, it has it has people who are subscribing to it, maybe in terms of the other customers that are actually paying premium and all those things, which it just needs to make them understand that there is a new, we are fully capitalized, you can take care of your, we have resolved the issue, so just keep coming to us. It doesn't, I think that is how I look at it, that structure, that name, even though the brand is a little bit damaged a bit, but people still know it exists. So you don't need so much marketing to make people know that this company has is there. They only need to know that this company has come up again. Somebody has bought into it again. That is just little awareness compared to starting from scratch, because I think that's how I look at it.
Okay, apart from regulatory constraint of license and everything, let's assume they can easily get license and there are no regulatory constraints. The reason why they might go, or why they should go for such insurance company, even though it's struggling, even though its structure is not that strong, is nothing other than customer base, existing customer base. Which means such insurance may have at least 100,000 customers, even though they are struggling, but they have 100,000 customers alone. Which means you are not starting from ground zero. Taking over 100,000 customers alone, and you trying to fine-tune it and try to know that this is a value you are now giving to them, is a good starting point rather than starting from ground zero. And what we mean by customer list is simply what we call the customer base. That is, you already have existing customer that you just need to come and preach to and say, this is a new wine that is being put in a new bottle for you guys, which you guys can take advantage of, and we are here as a new brand. You can say now, other than setting up insurance company of ABC, and you start to look for the first customer, the second customer, the third customers, and etc. And that is what I'm just trying for us to understand what we mean by customer list. What other examples do we have for an intangible asset that is obvious to us?
We have cryptocurrency held for capital appreciation.
I think we won't go to that level now, okay? Because that level is contentious to a certain level, okay? Even though there was a consensus agreed in the interim, but we won't go to that extent. But please take note of it. Probably we'll discuss that as we wrap up our discussion, okay, in the course of this session. Okay.
We have softwares
And etc. Now let's look up. These are practical examples of an intangible asset, starting from your software, patent, franchise, customers list, fishing rights, motion pictures rights, copyright, trademarks, and etc. Okay, but what you need to know is that for you to recognize any of this as an intangible asset, the criteria must equally be met, as discussed earlier. Now, what we are now going to do is to venture into discussing this criterion one by one. Okay, now let's pick the first criterion. The first criterion is, how do we identify an intangible asset? We said an intangible asset must be identifiable. And an intangible asset is identifiable once two conditions are met. One, once you have the legal rights. Okay, most intangible assets are backed by legal rights. Otherwise, you won't be able to more or less protect it from others being taking advantage of it to extract value. And secondly, it must be separable. Separable means that it must be what you can sell or you can use independent of other assets within the entity. Okay, once you meet these two criteria, you can conclude that such an intangible asset or set of activity are identifiable. And in that case, you have been able to pass the first criteria. Okay, and let me simply put it in summary. An intangible asset must be identifiable in order to distinguish it from goodwill, and with most physical substance, they must be identifiable so that if you're able to identify them, therefore, they've met the first criteria. And being able to identify them means, one, that you the entity has a legal right of ownership of that intangible asset. Now, for things like software, your legal right is easily obtainable from you paying for that software. But for things like copyright, your legal right is as a result of you registering with the Copyright Commission, or you having a patent, which is a legal right on your inventions. And this is what we need to take notes from the perspective of the standard. The second thing that makes it identifiable is that such a non-monetary asset with no physical substance must be separable from other assets or other intangible. Separable means it could be sold, it could be leased, it could be used independent of other assets. And until you meet these two, two conditions, you will not have satisfied the first criterion, which speaks to identification. Okay, the second aspect is to speak to control the entity has. Any question?
Yes, I wanted to say that, well, we mentioned you said, I mean, by definition of intangible assets, we saw that it must be non-monetary. Non-monetary, what does that mean? And like software, if software is categorized as an intangible, but it is purchased with money, so I cannot relate those two.
So this is exactly a question that has been propping up in my own mind too.
Okay, now how many of you have watched my video on IAS 21? How many of you?
Is it the one on foreign?
Yeah.
Yes, I watched it.
Effect of changes in exchange rate, and I believe you should have probably for the first time emphasis on monetary and non-monetary items.
I don't even remember. I know I've watched the video, but I can't.
Okay. When we say something is monetary asset or non-monetary, we are not saying that money is not involved. That's not what we are saying. What we are simply saying is that a non-monetary assets are assets whose value frequently changes in response to changes in economic and market factors or conditions. These are assets that reflect the level of price changes or that reflect the level of inflation. Examples of them are items of property, plant, and equipment. Let's pick land. The higher inflation rate in an economy, the higher the value of land. That's why people will tell you that land is a store of value. Let's pick inventory. Inventory also mimic level of inflation. That's why even when you have goods in store and you have not just purchased them and the price in the market to replace them as double, you will also double yours. Why? Because by nature, it must always reflect the price level changes. Does that make sense? These are what we call non-monetary assets. And this non-monetary assets, apart from inventory PP, it includes intangible assets such as Goodwill, copyright, and all sorts of things, because they immediately mimic the pattern of inflation. And that's why they will tell you that in the period of rising prices, non-monetary assets are compensated for possible loss of purchasing power. And that is why to compensate for it, their prices also skyrocket. Does that make sense? Unlike monetary items are items that are held in fixed determinable unit of currency, such as your receivable, such as your payable, such as your bank balances, such as your investment to some degree. Why? Because these are items by nature that if I buy goods from you 6 months ago and I have credits of 6 months, and as at the time I bought the goods from you for 1 million naira, inflation rate was 10%. 6 months after, as at the point I want to pay, inflation has risen to 21%. How much will I pay?
You still pay the same amount.
That is it. These are monetary items because they are held in fixed determinable unit of currency, which suffers loss of purchasing power. Do you guys see that? Which means as at the time you are receiving the money from me, you have lost value. Because 1 million you are receiving is not the same 1 million as at the time you make that sales. That's why they will tell you that from economic perspective, they will tell you that in the period of rising prices, holders of monetary assets lose value, while holders of monetary liability gain value. Because the same goods you are paying for 1 million, if you are buying it today, and you are paying today is 1.5 million. But you are paying 1 million for it today, all because you have locked it down in a fixed unit of currency, which does not reflect changes in price levels. Does that make sense? Therefore, that is what we mean by monetary items, so that you don't see it from the perspective of, but money is involved. No, that's not what we are saying. Does that make sense to you, Enaro?
Yes, yes, very clear, sir.
Okay. Now let's now look at the second criterion. For it to be intangible, which we have to recognize as an asset, it must be something controlled by the entity, which is still a general attribute for every asset. Issue of control. Now, control is what we emphasize. And what is control? The ability to make use of the assets so that it draws economic what? Benefit to you as an entity, in which the risk, significant risk and reward of holding such an asset lies with you as an entity. And I want somebody to make more emphasis on this. How do you identify that there is control over an intangible asset? Over to you guys.
Second criterion, control by the entity. Another element or the definition of an intangible asset is that it must be under the control of the entity as a result of a past event. The entity must therefore be able to enjoy the future economic benefit from the asset and prevent the access of others to those benefits. A legally enforceable right is evidence of such control, but not always a necessary condition. A, control over technical knowledge or know-how or only exists if it is protected by legal rights, IAS 38, paragraph 14. B, the skill of employees arising out of the benefit of training costs are most unlikely to be recognizable as an intangible asset because an entity does not control the future actions of its staff, IAS 38, paragraph 15. C, similarly, market share and customer loyalty cannot normally be intangible assets since an entity cannot control the actions of its customers, IAS 38, paragraph 16.
Thank you very much. Now, who can remind me of the last criterion? The last
Market or customer loyalty cannot normally be intangible assets. You know, and this is just a little bit contradictory to the issue of customer lists.
Okay, now let me give you a guidance. Later on in the course of our discussion, you will appreciate why the standard does not permit the recognition of some internally generated intangible assets. Okay, we won't be able to recognize some. Example is customers list. Due to what you just said now, customer loyalty cannot be, how will I say it? You can't hold customer perpetually. And on that basis, you don't have control over any customer. Which means a customer change in taste, fashion, or otherwise can make the customer move away, regardless of how you have satisfied such a customer. Even changes in technology can take customer away. Today, there's a big threat to the telecommunication industry with respect to data. Who can tell me the big threat they have in Nigeria today? Who can tell me?
Yeah, maybe
For me, I've
WhatsApp calls and
What's the biggest threat to them today?
with respect to what, sir?
The biggest threat to the likes of MTN, Globalcom, Airtel, and 9Mobile. What is the biggest threat to them today?
I think it's all these foreign companies where you can make free calls with your mobile data.
No, I'm talking of data now, which means what is the greatest competitor in the immediate future, in the next 1, 2, 3 years? What will be the greatest competitor? I want to know whether you are in tune with the dynamics of what is going on now.
I was even in that line of thought of checking that these internet calls. That was what I was looking at. But
okay, do you know about Elon Musk?
Yes.
What is Elon Musk trying to do
yes,
now?
yes.
What is he trying to do?
Is he about the space research that he's doing?
Yeah, what is the breakthrough he's having with the space exploration now, as it relates to data or internet expansion?
No, I don't know.
I think I heard about something that is social by you can this internet connectivity. Internet connectivity that people can easily connect. I don't think it's through what do you call it? Is it satellites? We're able to connect people without need for mask and everything. I think something is working towards something like that.
Okay. Do you know about Starlink? His products coming out, and they have said it's going to serve, the first batch of customers will serve about 500,000 customers globally. And Nigeria is one of those markets he has more or less identified. And are you aware that he has registered with Nigerian authority?
Yes, I'm aware Elon Musk wanted to come to Nigeria, but I don't know.
He's in Nigeria in principle.
Wow.
Okay. Therefore, the question then is, with that, there's no service you want to provide that can retain or that can have control over the customers in terms of loyalty, because once people see new technological breakthrough, internet penetration, expansion, speed, the same way you are talking of 5G and all sorts of things, what will happen? People will switch. Like we're having online classes now, we are still experiencing 1 or 2 glitches. And when that will be taken care of by this space, Starlink, direct connection to the space, do you understand? What do you expect? Which that means that these are the reason why it is not practicable to have control over customer loyalty. And that's why you find out later that customers list as an internally generated intangible asset cannot be recognized. The same thing for brands. It's only going to recognize upon business combination or acquisition, similar to the way we recognize goodwill. As you move on, you'll find out that goodwill also that is internally generated, which are called non-purchase goodwill or inherent goodwill, will never be recognized because of one factor or the other, which we are going to discuss. Does that make sense?
Yes.
Now, the third criterion speaks to expectation about future economic benefits. Even when you've met the first and the second criterion, you must meet the third criterion before you can recognize an intangible asset. And you meet this upon ensuring that one, that it is probable that this intangible asset will bring future economic benefit, which flows into the entity. And likewise, the cost of that intangible asset can be reasonably measured or ascertained. Until you add this before you can at any point in time recognize an intangible asset. Now let's look at the summary of that with respect to IAS 38. The third criteria, who will take it up for us?
Okay, I'll do that. Third criterion, expected future economic benefits. An item can only be recognized as an intangible asset if economic benefits are expected to flow in the future from ownership of the asset. Economic benefits may come from the sale of products or services or from a reduction in expenditure, that is cost savings. An intangible asset, when recognized initially, was measured at cost. It should be recognized if and only if both the following occur. A, it is probable that the future economic benefits that are attributable to the asset will flow to the entity. B, the cost of the asset can be measured reliably. Management has to exercise its judgment in assessing the degree of certainty attached to the flow of economic benefits to the entity. External evidence is best. A, if an intangible asset is acquired separately, its cost can usually be measured reliably as its purchase price, including incidental cost of purchase such as legal fees and any cost incurred in getting the asset ready for use. B, when an intangible asset is acquired as part of a business combination, that is an acquisition or takeover, the cost of the intangible asset is its fair value at the date of the acquisition. IFRS 3 business combinations explains that the fair value of intangible assets acquired in business combinations can normally be measured with sufficient reliability to be recognized separately from goodwill. In accordance with IAS 20 accounting for government grants and disclosure of government assistance, intangible assets acquired by way of government grants and the grant itself may be recognized initially either at cost, which may be zero, or fair value.
Okay. Now that speaks to all of our discussions under IFRS 3, if you could remember. Can you guys remember our extensive discussion?
Yes.
And you can still make reference to our video. Now, another thing we need to now discuss is, there can be exchange of assets in order to acquire an intangible asset. What does that mean? You can have one intangible asset and you exchange it to get another intangible asset, a form of barter trade or a trading. And it could also be any other asset in exchange for an intangible asset. The issue then is, how do we account for such? The first thing you need to establish is that, one, is there a commercial substance in this exchange? What do we mean by commercial substance? Can anybody elaborate on it? What do we mean by commercial substance? When you say a transaction like commercial substance, what does that mean?
Okay, for commercial substance, it means is a form of agreement that involve exchange of consideration. That is the agreement that is not in form of gift. It has for a discussion to be a commercial substance, it will be something that both parties agree as per the consideration that will be furnished in order to exchange the items. That is my submission with respect to commercial substance.
Okay, who else?
Yeah, I think I agree with Nurudeen that for something to have commercial substance, so it means there is a buyer and there is a seller and there is a consideration, you know.
Is it enough to just have a buyer and a seller and consideration to establish that there's a commercial substance?
I think that, hello?
We can hear you.
Yes, I was looking at it that when there is, when two parties, when there's an exchange between two parties, and in that situation, the exchange is done in such a way that the value they get is on market terms. On market terms. That is, the buyer is buying in order to, because of the economic benefit is going to get from that asset, and whatever the buyer is paying is actually a fair valued amount. And also, the transaction is not done because there is the attempt to defraud the system or to reduce tax, or all those kind of transactions that are done that is not arm's length and all those stuff. But that is the way I look at it.
Thank you. I think there are two key words or terms that you have made use of. Market terms, you said a transaction that is carried out at market terms and a transaction that establishes arm's length. Yeah. Now, it goes beyond buyer and seller. That's why we talk about market participants. A market participants go beyond buyer and sellers, but rather it speaks to buyers and sellers that are willing, knowledgeable, and rational in decision making. Two, for it not to lack commercial terms or substance, it must be done based on market terms. And that's why even the definition of fair value under Ifrs 13, emphasis was made on orderly manner, orderly transaction. And an orderly transaction is a transaction that is considered to have been carried out at arm's length, which is one of the terms that he used. Okay, and that's what we are trying to say now. That you are not just exchanging things based on relationship. You are not just doing it based on knowledge. You are not just doing it on the basis that it is skewed to one part than the other, but you are doing it in which a knowledgeable buyer and seller will have consummated such a transaction. It is only when we have such that we say the transaction entails commercial substance. And when it does not, we say such a transaction or exchange lacks commercial substance. Now, the first thing is this: exchange of assets that more or less bring about the possibility of recognizing an intangible asset must first of all have commercial substance. And two, such an exchange must be capable of being measured at fair value. If those two things are not in existence, it then means that you are going to recognize the intangible assets you have now at the carrying amount of the intangible asset or any other asset that you give up. Let me break it down. If you have a particular intangible asset before, the carrying amount of it is 1 million naira. and you now exchange that intangible asset for another intangible asset. The other intangible asset you are bringing in is supposed to be measured at fair value. But we are saying that it will be measured at fair value on the premise that one, it does not lack commercial substance. Two, the fair value can be reliably measured. But if this cannot be reliably measured, or it can be reliably measured but it lacks commercial substance, in such a situation, you will no longer use that fair value, but rather the kind amount of the intangible asset you gave up is what will be the recognized amount of this new intangible asset. Thereby, it does not result in a gain or a loss of the old intangible asset. Does that make sense now?
Yes.
Okay, now let's look at that from the perspective of the standard. What does the standard say in simple terms? Can somebody more or less express this on our behalf?
Okay, exchanges of assets. If an intangible asset is exchanged for another, the cost of the intangible asset is measured at fair value unless the exchange transaction lacks commercial substance, or the fair value of neither the asset received nor the asset given up can be measured reliably. Otherwise, the cost is measured at the carrying amount of the asset given up.
Thank you very much. Now let's now ask ourselves a simple question. Internally generated goodwill, does it constitute an asset and justify your position? Who will answer that? Internally generated goodwill, can we consider it as an asset and justify your position?
But by the standard is not an asset. Though his assets on it looks like an asset. It has almost all the criteria of an asset, but the standard says it's not an asset. I think because of I don't know the reason, but I would think that the reason why the standard says it's not an asset is because I think that the measurement, you have issues with measurement, a reliable measurement of it. That is what I see. But intangibles, intangibles, they are assets actually.
Yeah, thank you very much. Okay, now internally generated goodwill probably may have satisfied one or two conditions or one or two criteria, but has not satisfied the three criteria. Okay, and because of that, it can be recognized as an asset. If you remember, what are the three criteria? The first one is identification, which means it must be identifiable, and it's identifiable based on legal rights, and it must be separate from other assets or intangible assets. Two, we talked about that it must be controlled. Now, and thirdly, we talk about expectation for future economic benefit, which speaks to ability to direct that benefit to you as an entity and ability to be able to measure with reliability the cost of that intangible asset. Now, I'll pick two things that might make it impossible for us to treat it as an asset. One of it is that internally generated goodwill, is it separable? Can you separate it from other assets? Which means, can you sell your goodwill, which is your reputation, which is your loyalty you built over time, which is the quality of your products, Can you sell it independent of other assets? I think the answer there is no. 2, your intangible asset that is internally generated, can you determine the cost of generating it or developing it? I think that is clear to us, is vivid. And in that case, since we cannot satisfy those conditions, therefore, we will conclude that an internally generated goodwill does not qualify as an asset, and thereby it should not be recognized. This was the reason why we don't recognize inherent or non-purchase goodwill. Now let's look at it from this perspective. What does the standard emphasize on it once again?
Okay, internally generated goodwill. Internally generated goodwill may not be recognized as an asset. IAS 38 deliberately precludes recognition of internally generated goodwill because it requires that for initial recognition, the cost of the asset rather than its fair value should be capable of being measured reliably, and that it should be identifiable and controlled. Thus, you do not recognize an asset which is subjective and cannot be measured reliably.
Thank you very much. Now, we'll leave this and move to something critical. This has brought about some contentious issues over time, but over time, there will be more clarity about it, and it's about research and development costs. Do they qualify as an intangible asset, either individually or collectively? Now, who can distinguish between research and development? What is research? How does that differ from development?
So if I can just use an illustration. For instance, I think there was a time I was an intern at FIRO, Federal Institute of Industrial Research, and we're trying to see how we can make plastic from potato starch. Throughout that time of conducting the research, we do not really know what the outcome will be. We only read the theory and we're trying to see if we can replicate it. So based on that, throughout the time of trial and error, when you don't know whether you're going to be successful or not, you can't capitalize it. It is until you have that breakthrough that yes, this is a model, or you are certain that what you're doing we actually you will get the results from what you're doing. That is the extent that you can say, no, this is now development. By the time you are starting to build the model, by the time it is accepted by the committee of scientists or whatever, it is validated. So that is when we can say we have development. But as long as we are still doing research that we don't know what the outcome will be, then I think that will not qualify as an asset. It's only up to the point that you are certain that you have made a breakthrough and your breakthrough is capable of being monetized, of being sold. And also maybe the person you are working for or the organization have demonstrated sufficient interest in that model that you've built. And also, that this model is marketable. You can actually sell it. It's not as if something you are building that nobody is interested in, or there is even no market for it. So it is at this point that we can start to recognize development as separate from the research phase.
Thank you very much. Thank you very much. Now, research could be defined as basic research or forms of research, basic, applied, pure, unpure, and all sorts of things. But we are not interested in the division of research or the levels to research. As I have said before, research is just usually that borders on fact-finding, exploring alternatives, and doing all sorts of things towards trying to have a breakthrough. Okay, whereas development is a stage where you are trying to actualize the result of the research by trying to, I don't want to use the word develop it, try to, if it's something that will bring value, try to commercialize it, try to ensure that technical feasibility has been attained and commercial viability can be sustained. And that's when you say you have gotten to a developmental stage. Okay, the general conclusion, and there's a basis for this, of the standard is that research costs, no matter how you classify it, no matter how you describe it, no matter the outcome of it, will always not qualify as an asset. Why? Because not all of the criteria have been met with respect to it. One of the critical criteria that is not met by condition is expectation of future economic benefits. Remember, if you go back to conceptual framework, assets is defined from the perspective of economic resources. And that economic resources end product is to bring forth future economic benefits. Now, there is no amount of research you entail. Once it has not gotten to a level where it has passed both the technical feasibility test and commercial viability test, such cannot be recognized as an asset, because asset is not about your breakthrough. Asset is about economic benefit associated with what you have done. And in that regard, research will never be recognized as an asset. Rather, no matter the amount you expend on your research, it will be expensed as being incurred. Unlike developmental stage is when you tend to put things in shape to demonstrate technical feasibility and commercial viability. Those two conditions must be met for you to claim that this developmental stage now qualify as an asset, which means the output or the ongoing output of such a stage will now qualify as an asset. And that's why we'll now have to look at this extensively. That first, any research costs, no matter the nature, no matter how material it is, must be expensed as incurred. But when we get to development costs, we need to now evaluate it. All because not necessarily will all development costs be capitalized as an asset, because some may not have met the definition of an asset. Why? Because it might have passed a technical feasibility test, but unable to demonstrate that it can be put to commercial advantage, or it has not demonstrated commercial viability. And in that case, we will still expense such development costs. But where it has sustained the conditions that make it to be classified as an asset, at that point, we capitalize it as an intangible asset. Therefore, let us speak more volumes to this. Can somebody help me?
Internally generated goodwill. Internally generated goodwill may not be recognized as an asset. IAS 38 deliberately precludes recognition.
I think I read that one. It's research and development.
Research and development costs. Development costs are recognized as an asset if they meet criteria, if they meet certain criteria. An intangible asset is initially recognized at cost and subsequently carried either at cost or revalued amounts. Costs that do not meet the recognition criteria should be expensed as incurred. An intangible asset with a finite useful life should be amortized over its useful life. An intangible asset with an indefinite useful life should not be amortized. what is the relationship between research and development? Applied research carries the findings of basic research to a point where they can be exploited to meet a specific need, while the development stage of research and development includes the steps necessary to bring a new or modified product or process into production.
Okay, now that speaks volume to us. Now, the next thing we need to ask ourselves is very simple. Research as an activity, can we describe it? Can somebody give me a practical example of research? That I'm not talking about academic research within an organization.
Yeah, for instance, now, when there was an outbreak of COVID-19, a lot of organizations, like all these pharmaceutical organizations, started carrying out various research, in order to find the vaccine, to mitigate against the effect of COVID-19.
Which means what you are describing with respect to that research is that it's an activity aimed at obtaining new knowledge.
Yes.
Okay, or breakthrough. Okay, now the standard makes us understand that research could give you opportunity to break through with respect to new discovery or knowledge, or where you search for evaluation and financial selection with respect to application of research findings or other knowledge, the search for alternative materials, devices, product system, processes, and etc. You know that at a time, Nigeria, I think it's IITA that carry out a particular research on behalf of federal government with respect to using cassava as a substitute or a complement for flour, wheat, okay, for developing flour, which is a mixture of cassava. And I think that project started some time, and I think it has failed somehow. But I don't think...
at some point, Jonathan was talking about the cassava bread that's...
Yeah, I could say that I ate it one or twice, but I think what was missing is the finishing. I think the processing was not top-notch, so that its mixture with wheat has not been able to achieve what it needs to achieve. Okay, these are form of research activities. Now let's look at the description of research activity by IAS 38. Nurudin, over to you.
Research activities by definition do not meet the criteria for recognition under IAS 38. This is because at the research stage of a project, it cannot be certain that future economic benefits will be probably flow to the entity from the project. This is too much uncertainty about the likely success or otherwise of the project. Research costs should therefore be written off as an expense as they are incurred. IAS 38 paragraph 56 gives the following example of research costs. A. Activities aimed at obtaining new knowledge. B. Research for evaluation and final selection of applications of research findings or other knowledge. C. Research for alternatives for materials, devices, products, processes, system, or services. And D. The formulation, design, evaluation, and final selection of possible alternatives for new or improved materials, devices, products, systems, or services.
Okay, thank you very much. Now that is research, and anything associated to what we've seen there will be expensed outrightly without any question. But when you get to development costs, there are two sides to the coin, and we need to evaluate it carefully. Now, the first thing we need to consider is that does the development cost meets the set criteria. There are about 6 criteria that need to be met before development cost can be considered to qualify as an asset or as intangible asset, as the case may be. But once at least one or more of these criteria are not met, in that instance, the development cost will not be recognized as an asset. It will be treated the same way we treat research cost. But these 6 criteria can be summarized from my own research to 2 conditions, which means these 6 criteria more or less revolves around 2 conditions. The first condition is about technical feasibility. Has that test been passed? And the second condition revolves around commercial viability, which speaks to ability of it to generate future economic benefit. In that regards, if such has been met, the standard says such developmental cost will constitute an intangible asset. Thereby, the associated cost of that developmental stage should be capitalized as an intangible asset. And that is that. Okay, and the standard makes us understand different aspects of development in stages, and also try to identify the later stage, or probably the final stage of a development. Now, let us look at development from the perspective of IAS 38.
Development costs may qualify for recognition as intangible assets, provided that the following strict criteria can be demonstrated. 1, the technical feasibility of completing the intangible asset so that it will be available for use or sale. 2, the entity's intention to complete the intangible asset and use or sell it. 3, the entity's ability to use or sell the intangible asset. 4, how the intangible asset will generate probable future economic benefits. Among other things, the entity should demonstrate the existence of a market for the output of the intangible asset, or the intangible asset itself, or if it is to be used internally, the usefulness of the intangible asset. 5, the availability of adequate technical, financial, and other resources to complete the development and to use or sell the intangible asset. The entity's ability to measure the expenditure attributable to the intangible asset during its development reliably. Once these criteria are met, IAS 38 requires development expenditure to be capitalized. That is, there is no option of not capitalizing it. In contrast with research costs, development costs are incurred at a later stage in a project, and the probability of success should be more apparent. IAS 38 paragraph 59 gives the following examples of development costs: the design, construction, and testing of pre-production or pre-used prototypes and models. 2, the design of tools, jigs, molds, and dies involving new technology. 3, the design, construction, and operation of a pilot plant that is not of a scale economically feasible for commercial production. And 4, the design, construction, and testing of a chosen alternative for new or improved materials, devices, products, processes, systems, or services.
Okay, thank you very much. Okay, thank you very much. That is our position. Any question on that before we forge ahead? Any question on that? Now, again, the standard does not forbid the recognition of internally generated intangible assets, except for goodwill. Goodwill outrightly, and we have discussed that extensively, even from the perspective of IFRS 3 and further from the perspective of IAS 38. Now, but there are other internally generated intangible assets that are forbidden of being recognized, similar to how goodwill, internally generated goodwill, is not recognized. And this is because by nature, some of these does not meet all of the criteria. Probably they fail 1, 2, or more of the criteria towards the recognition of an intangible asset. Can you think of 1 or 2, even though I've mentioned 1 today, but I'll pardon you to mention that 1 again to see whether you are following me. Can you give me example, practical example of 1 or 2 that are internally developed or generated as an intangible asset within an entity, but by the virtue of not meeting the 3 criteria, they cannot be recognized as an intangible asset? Who will guide me?
Okay, we have the customers list.
The customer list. Okay. Can you explain why again?
Okay, why it is not permitted is because you cannot prevent, you cannot stop a customer from switching from your product or from your company into another one. So you cannot determine the action of a customer in the nearest future. So as such, you cannot say you will generate future economic benefit from it.
Yeah, and likewise, you have no legal right on them to say, but last year when I did promo, you won car, therefore how come you are not patronizing me again? There is no such. Therefore, you don't have the control to tie down customer. You know, sometimes you have done everything for a customer, but God says you are not necessarily getting what you need to get. And that is how it is. Do you get what I'm saying now? Okay. And couple the fact that any action taken by customer is presumed to be right. Therefore, you have no control over such customer. Okay. Now, who can give me 1 or 2 examples again?
I have a brand image.
Brand, yeah.
We have brand, we have software.
Software, that's not necessarily correct. Software, you have cost attributed to it. You know, cost of developing a software is humongous.
Yeah.
Cost of the people, salaries, inventor, trial, test, pilot, and all sorts of things. That one is straightforward. Okay, most of others is because you cannot reliably identify their costs. You get what I'm saying now? And therefore, let's look at it from this perspective. What are the standards says especially?
I think you can also have employees training.
Now, for example, training employee.
Yes, you know, you can say, though you've trained your employees, you cannot place because of that.
Training is different from employee development. For example, there are aspects of employee training, which we call employee development, that you can capitalize as intangible assets. Example, if you have management staff that is sent for advert training, probably advert training of 6 months, 9 months, 1 year, or 2 years. And part of the agreement you sign is that you cannot leave this organization in the next 5 years or 10 years. Otherwise, the cost of this kind of employee developmental process plus other value attributable to it will be paid back to the company as compensation. In that regard, you can capitalize it. Okay? But any other one, in that regard, you cannot. Now, let's look at what the standard says here. The standard prohibits the recognition of internally generated brands, mastheads, publishing titles, and cosmetics and similar items as intangible assets. The reason being that they fail one or two criteria in the recognition of an intangible asset. And similarly, they are seen in the same light we saw internally generated goodwill. And on that basis, we are not meant to recognize them at any point in time. But the only exception to recognizing them is only if it is what you paid for as a result of business combination. Does that make sense? Which means it's upon acquisition of a business that you can only recognize them. Okay, any other question? Now, let's now look at it. I want somebody to guide me further on this. Cost of an internally generated intangible asset. Can you reliably measure them? To what extent?
Cost of an internally generated intangible asset. The cost allocated to an internally generated intangible asset should be only costs that can be directly attributed or allocated on a reasonable and consistent basis to creating, producing, or preparing the assets for its intended use. The principles underlying the cost, which may or may not be included, are similar to those for other non-current assets and inventory. The cost of an internally generated intangible asset is the sum of the expenditure incurred from the date when the intangible asset first meets the recognition criteria. If, as often happens, considerable costs have already been recognized as expense before management could demonstrate that the criteria have been met, this earlier expenditure should not be retrospectively recognized at a later date as part of the cost of an intangible asset.
Okay, thank you very much. Now we are going to look at it from this perspective. Okay, the perspective is this. At what point do you start to capitalize development costs or capitalize intangible asset costs? Now, you only capitalize from the point it has met the criteria, which means any cost associated to an intangible asset before it meets the criteria will be expensed regardless of the amount involved. Take note. If you have incurred money in searching for information, new development, and all sorts of things, all of those ones constitute research. They'll be expensed. Until you cross the barrier, any cost you now incur at the point of development, where one, you've met the technical feasibility and you have more or less surpassed the commercial viability, every cost incurred will be aggregated and capitalized as an intangible asset. But any cost you have incurred prior to that is in principle sunk and must be expensed. It has no bearing with the intangible assets. Now, to see whether we have better understanding of that, I'll put before you a short exercise.
Please, can I ask a question?
Yeah, okay.
Okay, what about in a situation, is it possible to jump the research stage and move to development? For instance, maybe you just take from public domain an already concluded research that you think is viable, and you just bring it into your organization and start developing it. And
Yes.
That's okay.
You can do that, which means it's not your invention. We are not discussing whether you invented, but we are saying that whether you are the one that invented it or not, we are looking at cost at the developmental stage, which has passed the two conditions of technical feasibility and commercial viability. Okay, but you can't tell me you are developing something when there is no basis to developing it. We are saying that the cost of having the basis to developing it is a research cost or part of development cost that has not met the 6 criteria. Does that make sense? And that is it. You, as we move on, you understand and appreciate why such is required. Now let's look at this exercise, and I want you guys to deliberate on it, and let's see whether what we've learned so far, we can be able to harness it in solving this problem. Over to you guys.
Okay, let me read it. DOCO is developing a new production process. During 20X3, expedition incurred. Okay.
Okay, I'll put it as 2013
Okay.
to make
during
more realistic.
Okay. During 2013, expedition incurred was 100,000, of which 90,000 was incurred before 1st December 2013 and 10,000 between 1st December 2013 and 31st December 2013. DOCO can demonstrate that at 1st December 2013, the production process met the criteria for recognition as an intangible asset. The recoverable amount of the know-how embodied in the process is estimated to be $50,000. How should the expenditure be treated in 2013?
Okay, I want guidance. Who will guide us? Okay. Look at the question critically.
Okay, so if I can just say something about this, the total amount spent so far is $100,000, and before 1st December 2013, $90,000 had been spent, and between 1st December 2013 and 31st December, 10,000 was spent. So it is between that 1st December and 31st December that the entity can really demonstrate that the production process meets the criteria for recognition as an intangible asset. And I want to believe that it is at this point that we have technical feasibility and commercial viability. So now, all the expenditure incurred up to 1st of December should be recognized as an expense because they constitute research. And those ones between 1st of December and 31st December should be capitalized as intangible assets. But the question now is that how much should we recognize as development cost? Because 10,000 is the amount actually incurred on development, whereas the recoverable amount of the know-how embodied in the process is estimated to be $50,000. So I want to see that this recoverable amount represents the current value, or maybe market value or fair value or whatever we want to call it, you know, that's that is embedded in this development. So as far as I'm concerned, at initial recognition, I will go with recognizing the costs, which is this $10,000 rather than $50,000. Maybe subsequently, this could be recognized at $50,000, but at initial recognition, it to be recognized at cost.
Now, what will you now do with the portion you need to recognize? What will you do with the portion not recognized?
The portion not recognized, you mean the $90,000?
Yeah.
Yeah, it will be expensed as a research costs in the POL.
Okay. Any other perspective?
Okay, my perspective is thus. Since I want to believe that the company's account is prepared at the end of the year, which is 31st December 2013. So, and also the expense, I mean the cost spent during that year was 100,000. Though on 1st December, that was when it was determined that the production process has met the criteria for recognition and everything. But I believe that in account we do the annual basis. So basically, since it is the amount spent for the year was 100,000, and not the exact dates in that year. I'm looking at recognizing the 100,000 as the cost of the intangible assets. That's why I look at it.
Okay, Nudin, can you be the umpire by looking at this suggested solution?
Okay. At the end of 2013, the production process is recognized as an intangible asset at a cost of $10,000. This is the expenditure incurred since the dates when the recognition criteria were met. That is 1st December 2013. The $90,000 expenditure incurred before 1st December 2013 is expensed because the recognition criteria were not met. It will appear form part of the cost of production process recognized in the statement of financial position.
Okay, now, and now, what's your perspective to that? Does that change your mindset?
It does. But the only thing is that, in accounting, the date issue, it was on 1st December. This is theoretically is feasible, but in practice, it's easier to know the year than to know the exact date
Well, in practice, you even know more of the exact date because every process of research development are documented.
Exactly.
They are documented. Probably because you are more or less in finance session, you don't know what goes on within those kind of product development and some other things. They are not things that you just do. Every process is documented. For example, if you go back to Johnson & Johnson, you go back to those that have developed a vaccine, they can give you timeline of everything that was done because it's a thoughtful process. It's not something that was just done by chance. Okay, now let's look out for how do we recognize expense in this regard. Now, all expenditure related to an intangible asset which does not meet the criteria set, the three criteria, if you remember, first is identification, second is control by the entity, and the third is expectation for future economic benefit. Once they are not met, okay, and in that case, you are not recognizing them as intangible assets, neither you recognize them as goodwill that might have arose from a business combination. In that regard, all expenses will be expensed as they are incurred. An example of them is like startup cost, training cost, advertising cost, business relocation cost, business restructuring cost. All of these costs are going to be expensed because they are not integral in the developmental stage or phase of creating an internally generated intangible assets. But there are some elements of this cost that might have been prepaid, though they do not qualify as intangible assets, but they might be recognized as prepayment, which is another class of asset. For example, if you are prepaid for adverts for 1 year, and that 1 year cut across 2 accounting periods, therefore, you know that you are going to recognize prepaid assets or other assets. And in that case, you'll be amortizing it on a monthly basis or on the basis to which the advert has been delivered. Let's take note of that. Any question from that perspective? Any question from this perspective? Any question from this perspective? Okay, if there's no question, let's look at how do you measure an intangible asset? How do you measure intangible assets? Now, at initial recognition, intangible assets must be measured at cost, and that is why it forms part of the condition within the third criterion. Remember, the third criterion speaks about the expectation of future economic benefits, and it has been concluded that one of those conditions that satisfy expectation of future economic benefit is ability to ascertain the cost of that intangible asset, whether the cost of purchasing it, which is acquiring it, cost of developing it or creating it, must be reasonably and reliably ascertained. Otherwise, at that point in time, such item will not qualify. And which means upon initial recognition, all intangible assets that qualify for recognition must be recognized at cost. But subsequently, similar to what we know under IAS 16, property, plant, and equipment, IAS 38 also makes us understand that there are 2 models that can be alternated in the recognition or in the subsequent measurement of an intangible asset. The first one is what is much more the practice. Intangible asset practically should be carried or measured at cost, which means the cost model should be used so that the cost will now be amortized over the useful life of an intangible asset. And that cost also will be subjected to impairment, apart from amortization. But again, we'll get to understand that not necessarily all of an intangible asset has a more or less like determinable useful life or finite useful life. Okay, those that have finite useful life, those that you can reliably measure or ascertain or estimate their useful life will be amortized on a systematic basis that reflect the economic benefit over that useful life. But we also made note that there are some intangible assets that their life is indefinite, indeterminate. And in that case, their useful life cannot be reasonably ascertained based on the fact that you don't have that knowledge of ascertaining it due to the nature or other circumstances regarding that asset. Now, in that situation, such an intangible asset will not be amortized, but such will not escape impairment test. And the impairment test in that regard will be carried out at least once every year. And that speaks to what we discussed in the last class, which you can go back to watch the video on IAS 36. Okay, and that is that. Now, the second model, even though it's permitted, but it's less likely that such model may be adopted for some intangible asset. And what is that model? Is the revaluation model, or what you call using the revalued amount as a model for intangible asset. And this model means that intermittently, once there is more or less a disparity between what the fair value is of such an intangible asset and what the kind amount is, you will have to revalue such an asset upward to reflect what the fair value is. And which means the cost model and valuation model of IAS 38 is similar and somewhat in tandem with that of IAS 16. And again, certain conditions exist for you to be able to use that model. Revaluation model is less likely to be adopted for intangible assets, except if certain things can be achieved. One of those things that can be achieved is that, one, there is an active market to which such an intangible asset can be purchased or sold, or a market that exists where it can easily be valued. Another condition there is that whenever you have an intangible asset under a revaluation model, you must ensure that the entire class of that intangible asset, which means the class to which that intangible asset relates, must equally be measured at revalued amount, and such must be carried out at the same time in order to prevent selective revaluation at various times. Another thing there is that peradventure, the active market disappears 2 years after, 3 years after, or more, and you are unable to be able to estimate the fair value. The standard allows you to default to deemed cost, whereby you depreciate the last kind amount, or you amortize the last kind amount. Let me use the appropriate nomenclature. You amortize the last kind amount over the remaining useful life and still subjected to impairment. And lack of active market is also a trigger for possibility that such an intangible asset may have been impaired. And other one also is that regularly you have to reevaluate all conditions to ascertaining the kind amount, including the possible useful life of such an asset. But we are going to see some of other conditions as shown from the perspective of the standard. Now let's look at the details as provided by the standard so that we can have better appreciation. Who will take me through?
I will. Measurement of intangible assets subsequent to initial recognition. The standard allows two methods of valuation for intangible assets after they have been first recognized. Applying the cost model, an intangible asset should be carried at its cost, less any accumulated amortization and less any accumulated impairment losses. The revaluation model allows an intangible asset to be carried at a revalued amount, which is its fair value at the date of revaluation, less any subsequent accumulated amortization and any subsequent accumulated impairment losses. A, the fair value must be able to be measured reliably with reference to any active market in that type of asset. B, the entire class of intangible assets of that type must be revalued at the same time to prevent selective revaluations. C, if an intangible asset in a class of revalued intangible assets cannot be revalued because there is no active market for this asset, the asset should be carried at its cost, less accumulated amortization and impairment losses. D, revaluation should be made with such regularity that the carrying amount does not differ from that which would be determined using fair value at the end of the reporting period.
Okay, thank you very much. Now, let's not speak to revaluation. The same position we took under IAS 16 and as discussed further with respect to IAS 36, if you go back to the videos, you'll discover that that same position applies strictly to IAS 38. Now, where the evaluation model has been chosen, you must understand that if in the first year, the asset was revalued upward, the revaluation surplus will not be reported to profit or loss. Rather, it will be reported directly in equity. as a reserve. Okay, which means it will be reported through other comprehensive income. Now let's look at it that, okay, an asset that last year was revalued upward. This year, such an asset has been deemed to have suffered impairment. Now, the impairment loss will first of all be charged to the revaluation surplus in order to nil it off. And if the impairment loss charge is lower than the surplus, it means the balance in the surplus will still be maintained as a revaluation reserve. But peradventure, the impairment loss carried out this year is more than the revaluation surplus. It then means that the portion that will more or less bring the surplus to zero will be treated as revaluation decrease. And any excess amount over that revaluation surplus will be the amount of impairment loss that will be charged directly to profit or loss. Similarly, if an intangible asset that is carried at a value amount was initially measured so that it had first experience of an impairment loss, such loss will have been charged directly, similar to what we did under PPE, to profit or loss. Now, subsequently, if there's a revaluation gain from such, or revaluation surplus from such revaluation exercise, such revaluation gain or surplus will first of all be used to zeroize the impairment loss already charged to the profit or loss. It is the excess over what has been charged to profit or loss that will now be recognized as revaluation surplus, which means you first of all reverse the revaluation decrease, which was the impairment loss, up to when it becomes a zero. And anything in excess of it will now be recognized in your financial statement as a revaluation surplus. Now, these are the positions that have been taken, and it's exactly in tandem with that affect an items of property, plant, and equipment. Now, let's look at the guidance that is.
Can I ask a question, sir?
Yes, sir.
Okay, in a situation whereby we first nil off the previous revaluation gain and the previous revaluation loss, and the excess gain was now recognized as income in the profit or loss.
Not profit or loss, in other comparison.
Okay, for instance, we first nil off the previous revaluation gain.
Let me give you the guidance.
Okay.
Last year was the first time we had anything to do with the impairment, the intangible assets. 3 years ago, we had the intangible assets. Last year, it was impaired, and we charged impairment loss to profit or loss for 10 million. This year, there's a condition that has improved or resuscitated that intangible asset, so that by revaluation of that intangible asset, we have a revaluation gain of, let me say, 12 million. What we are saying is that 12 million will not go to revaluation surplus through OCI. No. 10 million will go to your profit or loss at the form of impairment gain in order to reverse last year impairment loss. The 2 million in excess of that 10 million will now be reported to revaluation reserve through other comprehensive income in the current year. Now, I want you to read these guidelines, which will more or less solidify what I've explained.
Is all right. Measurement of intangible assets subsequent to initial recognition. The standard allows two methods of valuation for intangible assets after they have been first recognized. Applying the cost model, an intangible asset should be carried at its cost less accumulated amortization and less accumulated impairment losses. The revaluation model allows an intangible asset to be carried at a revalued amount, which is its fair value at the date of revaluation, less any subsequent accumulated amortization and any subsequent accumulated impairment losses. A, the fair value must be able to be measured reliably with reference to an active market in that type of asset. B, the entire class of intangible assets of that type must be revalued at the same time to prevent selective revaluations. C, if an intangible asset in a class of revalued intangible assets cannot be revalued because there is no active market for these assets, the asset should be carried at its cost less accumulated amortization and impairment losses. Revaluation should be made with such regularity that the carrying amount does not differ from that which will be determined using fair value at the end of the reporting period. The guidelines state that there will not usually be an active market in an intangible asset. Therefore, the revaluation model will usually not be available. For example, although copyrights, publishing rights, and film rights can be sold, each has a unique sale value. In such cases, revaluation to fair value would be inappropriate. A fair value might be obtainable, however, for assets such as fishing rights or quotas or taxi cab licenses. Where an intangible asset is revalued upwards to a fair value, the amount of the revaluation gain should be credited directly to equity under the heading of revaluation surplus. However, if a revaluation gain is a reversal of a revaluation decrease that was previously charged to profit or loss, the gain can be recognized in profit or loss. Where the carrying amount of an intangible asset is revalued downward, the amount of the downward revaluation should be charged to profit or loss unless the asset has previously been revalued upward. A revaluation decrease should be first charged against any previous revaluation surplus in respect of that asset.
Okay, thank you. Now let's demonstrate our understanding with this question. I want somebody to be able to provide guidance to this question.
Sorry. Before we do that, let me just ask a question, Mr. Miwa. So, based on what was read now, and I'm looking at it vis-a-vis IAS 16, an asset that is carried at revalued using the evaluation model, that is intangible assets, using the evaluation to carry it subsequently. It says that the fair value at that date less the any amortization, subsequent amortization and impairment. So basically, my question is this: if an asset, intangible asset is revalued today at its market value, let's say its market value now today, fair value today is 10 million. Are we going to deduct the previous amortized costs, or is just a subsequent one I'm going to deduct? I don't know if you get my question.
Okay, the first thing you need to know is this: if you revalue an asset and the valuation amount is 10 million, what do you compare it with? You compare it with the carrying amount, which might have been subjected to amortization. And the difference between the carrying amount, which is the balance of the value of that asset before evaluation, and the valuation amount, the difference of it is what we recognize as the valuation surplus. I didn't get what other thing you are talking about.
Okay, what I'm saying is that if you revalue an asset today, an intangible asset today, 10 million, that's the asset value. Now that 10 million, for you to get will it be the carry amount, will it be
the carrying, the new
previous amortized cost?
No, wait, sir. The new carrying amount is the revaluation amount, very simple. And going forward, the new amount is what you will be amortizing. I didn't get all that thing you are talking about.
Okay, so the new amount, you are not going to deduct.
Before you carry out evaluation, you have determined the carrying amount as at that date, which is after you have amortized.
Yes. They determine that the fair value today is 10 million. That is the fair value for today. That is the valuation amount. So yes, from that day, you continue to amortize. You don't need to deduct the previous.
No, you can't deduct the previous.
Amortization.
You can't deduct the previous. That means you are deducting 2 times. The kind of amount that you used to compare with the valuation amount is already net of that deduction. Therefore, why are you deducting again in that same year? Do you get it
okay,
right?
Because I was listening to, because when Chegun was reading, he said, subsequent amortization. So less amortization, less subsequent amortization. I don't get that.
Subsequent amortization mean? Subsequent means from next year.
from next one. Okay. Because okay, less should obviously be what are taking place before. That's what I wanted to find out. Okay, no problem.
Okay. Now, can somebody test to answer this question? Let me read the question. An intangible asset is measured by a company at fair value. The asset was revalued by $400 in 2013, and there's a revaluation surplus of 400 in the statement of financial position in that 2013 because of this revaluation. At the end of 2014, which is a year after, the asset is valued again, but in this case, it had a downward valuation of $500. The question then is, state what will be the appropriate accounting treatment for the downward revaluation. Who will answer that?
Okay, let me try to answer that question. The accounting treatment for the downward revaluation will good thus. In the first instance, revaluation surplus account that has received $400. When I want to treat my downward valuation of $500, what I would do is to debit $400,000 to my revaluation surplus account to reduce it by the exact $400 that the asset was valued initially in 20x3. That will make my revaluation surplus account to be nil. Then the excess $100 will now be debited to my expense income statement of profit or loss accounts as an expense. Thank you.
As impairment loss.
Sorry, as impairment loss.
Yeah. Okay, let's see what happens in that. Can you read out the solution? Can you read out the solution?
The solution has not dropped on the drop. Okay. In this example, the downward valuation of $500 can first be set against the revaluation surplus of 400,000. The revaluation surplus will be reduced to nil, and a charge of $100 made as an expense in 20x4.
Okay. Thank you. Let's look at other considerations for evaluation. Now, this consideration is not new because the consideration we are going to look at now is exactly in tandem with that of IAS 16. Okay, what happened is that whenever you have revaluation surplus, as you continue to depreciate an asset or amortize an asset, you have two options. First option is you can be transferring a portion of that revaluation surplus to your retained earnings to reflect the same pattern to which you are amortizing that intangible asset, or you are depreciating that property, plant, and equipment. Or you leave it there en bloc until when the asset is derecognized, either through disposal or when the assets no longer have future economic benefit and it has been abandoned. And in that situation, you transfer the entire surplus from revaluation reserve to your retained earnings. Now let's look at what the standard demonstrated. Other consideration.
Other considerations. When the revaluation model is used, an intangible asset is revalued upwards. The cumulative revaluation surplus may be transferred to retained earnings when the surplus is eventually realized. The surplus will be realized when the asset is disposed of. However, the surplus may also be realized over the time as the asset is used by the entity. The amount of the surplus realized each year is the difference between the amortization charge for the asset based on the revalued amount of the asset and the amortization that will be charged on the basis of the asset's historical cost. The realized surplus is, in such cases, should be transferred from revaluation surplus directly to retained earnings and should not be taken through profit or loss.
Okay, thank you very much. Now, let's look at it. Useful life of an intangible asset have to be ascertained, but there are two perspectives to it. The first perspective is that the useful life of an intangible asset may be finite, that is determinable, 5 years, 10 years, 15 years, 20 years, as the case may be. And in extreme case, it might be indefinite or indeterminable, because you cannot reasonably expect that this is a period to which you could have it. A common example of such is Goodwill, from our discussion from a business combination. Now the question then is, for those that are finite, every year you must reassess the useful life in order to see whether it could be prolonged, it could be shortened, or it could be retained. Similarly, for those that are indefinite or indeterminate, you must also assess them at least once every year to determine whether they are now in a position to reasonably ascertain or determine the useful life, so that what was once indeterminable is now determinable or finite. And the standard makes us understand that there are various factors that you need to take into consideration in order to estimate or determine the useful life of an intangible asset. One of those things is, what is your pattern of usage or consumption of that intangible asset? Another thing is to look at what is the life cycle of it. Another thing is, what legal right do you have? For example, if you buy a software and you only have right to that software for 5 years, that legal right has restricted you that you can't use it for more than 5 years. Okay, another thing you can look at is, okay, what is the maintenance culture or expenditure, so that after this number of period, the cost of maintaining it or repairing it might outweigh the benefit. And in that case, you believe that the useful life cannot extend beyond that period in which you can obtain maximum benefit. You look at technical factors, technological changes, commercial concentration, obsolescence, and some other things with respect to industry standards. These are what the standard has provided for us as guidance at every point in time to estimate the useful life of it. Why do we need this? Is because when we are to amortize the cost or the revalued amount of an intangible asset, the useful life will be a critical factor or consideration or variable in determining the amount that constitute our amortized charges. In that case, let's look at what the standard says with respect to useful life of an asset.
Useful life. An entity should assess the useful life of an intangible asset, which may be finite or indefinite. An intangible asset has an indefinite useful life when there is no foreseeable limit to the period over which the asset is expected to generate net cash flows for the entity. Many factors are considered in determining the useful life of an intangible asset, including expected usage, typical product life cycles, technical, technological, commercial, or other types of obsolescence, the stability of the industry, expected actions by competitors, the level of maintenance expenditure required, legal or similar limits on the use of the assets, such as the expiry dates of related leases. Computer software and many other intangible assets normally have short lives because they are susceptible to technological obsolescence. However, uncertainty does not justify choosing a life that is unrealistically short. The useful life of an intangible asset that arises from contractual or other legal rights should not exceed the period of the rights, but may be shorter depending on the period over which the entity expects to use the assets.
Okay, thank you very much. Now, we'll now look at how do we allocate the costs of an intangible asset. Allocating the cost of an intangible asset is simply saying that how do we amortize the cost of an intangible asset such that a portion of it will be recognized on a periodic basis over the amortization period as an expense in our profit or loss. And the standard has made us understand that the critical factor to amortizing the cost of an intangible asset is the expected useful life of that intangible asset. And such cost is expected to be amortized over the useful life. And the standard also makes us to understand that the pattern of consumption or usage of that intangible asset is instrumental to its amortization. The standard also makes us understand that the earliest date to which you cease to amortize or the date you stop amortizing an intangible asset is the earliest of the date the asset is classified as held for sale. Remember, held for sales is under the requirement of IFRS 5, which is non-current asset held for sale and discontinued operation. And we are comparing the earlier of that date when it is classified as held for sale in line with IFRS 5 and when the asset has been disposed of or outrightly derecognized. At that point, you stop amortization, which means the current amount will not be derecognized in order to ascertain whether there's a gain or loss on such a derecognition, especially as attributed to disposal of an intangible asset. Another thing is that at every point in time, your pattern of future economic benefit associated with that intangible asset is critical to determining the basis of amortization, which means amortization should reflect the pattern of economic benefit associated with that intangible asset. But the standard makes us understand that if it's practically not possible for you to more or less identify the pattern of future economic benefit or its distribution, you should resort to more or less a straight line method. And that's why you find out that most amortization of intangible assets is on a straight line basis. And again, we must all understand, similar to what we know about depreciation, that amortization cost or amortized charge of an intangible asset will be recognized regardless of the nature of that asset in your profit or loss, similar to the way we recognize depreciation. Another thing we need to know is that the standard says that it is less likely for any intangible asset to have a residual value, unlike item of property, plant, and equipment. What it simply means is that because of the nature of intangible assets, of not necessarily having market value, what do I call it, a second-hand value, so that you can easily sell it or transfer it to another party. Therefore, it might be impracticable to have residual value estimated for an intangible asset, which means the standard presumes, except if it's rebutable, that the residual value of intangible assets should be zero. Okay, but the standard provides exception where it can be non-zero. One of the exceptions is that if already you have an agreement with a third party that might likely buy or take over such an intangible asset at a monetary value in the future, as at the time you inducted such an intangible asset, such situation might create a situation where you have intangible asset having a residual value. Another thing is that if it's also practicable based on some other intangible assets where they have active market to which second-hand value can be traded, in such a situation, you are expected to equally estimate based on that second-hand value, which is obtainable in an active market. Otherwise, the residual value of an intangible asset should be zero. But again, on a yearly basis, you carry out a reassessment to determine whether there's a need. The same way you carry out your assessment to determine useful life, you also carry out a reassessment to determine whether residual value could still maintain zero or is no longer zero, or vice versa. And all of this must be done at every reporting date. Now let's look at the position of the standard with respect to amortization of an intangible asset. Over to you.
Okay, let me read this. Amortization period and amortization method. An intangible asset with a finite useful
Amortization
life.
asset.
Pardon? Can you hear me? I'm reading.
Yeah.
Okay, I say, oh, sorry. An intangible asset with a finite useful life should be amortized over its expected useful life. A, amortization should start when the asset is available for use. B, amortization should cease at the earlier of the date that the asset is classified as held for sale in accordance with Ifrs 5, non-current asset held for sale and discontinued operations, and the date that the asset is derecognized. C, the amortization method used should reflect the pattern in which the asset's future economic benefits are consumed. If such a pattern cannot be predicted reliably, the straight line method should be used. D, the amortization charge for each period should normally be recognized in profit and loss. IAS 38, paragraph 57. The residual value of an intangible asset with a finite useful life is assumed to be zero unless a third party is committed to buying the intangible asset at the end of its useful life, or unless there is an active market for that type of asset so that its expected residual value can be measured. And it is possible that there will be a market for the asset at the end of its useful life. The amortization period and the amortization method used for an intangible asset with a finite useful life should be reviewed at each financial year end.
Okay, thank you very much. Now, let's now look at what I said earlier with respect to intangible assets with indefinite useful life. What you need to do on an annual basis to revisit whether such will continue or otherwise.
Intangible assets with indefinite useful lives. An intangible asset with an indefinite useful life should not be amortized. IAS 36 requires that such an asset is tested for impairment at least annually. The useful life of an intangible asset that is not being amortized should be reviewed each year to determine whether it is still appropriate to assess its useful life as indefinite. Reassessing the useful life of an intangible asset as finite rather than indefinite is an indicator that the asset may be impaired, and therefore it should be tested for impairment.
Now, on that basis, let's look at this practice question as a guide. It may be difficult to establish the useful life of an intangible asset, and judgment will be needed. The question then is, consider how to determine the useful life of purchased brand name. How will you determine the useful life of a purchased brand name? Give us an example of a brand name that you can purchase as a Nigerian business. And tell us how you can determine the useful life. What are the practical considerations to determine the useful life of such a brand? Pick a brand. Pick a foreign brand that a Nigerian company can harness.
We have TFC.
Okay.
TFC is
KFC.
KFC.
Okay. Now, having picked KFC, for example, can you give me a practical demonstration of factors that you consider to determine the useful life of that KFC brand?
Okay, for me, I think you look at the contract, how long it will last. So that's one we definitely determine.
Given to you, what
Pardon?
is it? The franchise given to you, for how many years is it given to you?
Yes. That is one.
So,
apart from that, if the continue, Shegun.
Okay, I think another thing you can also look at is how long you indeed want to use that franchise. For instance, probably even the organization that is purchasing a foreign franchise also has an ambition to develop a local franchise, which, at a particular time, you will have to withdraw that foreign franchise you are using and embark on your own local franchise. So if there's an internal arrangement like that, so you will look at, even though the international franchise you are getting is for 10 years, but you are planning that by the end of the year 8, you want to switch to your own local franchise, then I think you should amortize over those 8 years that you have in mind.
okay, that's a good consideration. What other one? Okay, in order not to waste our time, can you take us through these factors that you would have considered for the KFC franchise as being purchased by a Nigerian company?
Factors to consider would include the following. A. Legal protection of the brand name and the control of the entity over the illegal use by others of the brand name, i.e. control over pirating. B. Age of the brand name. C. Status or position of the brand in its particular market. D. Ability of the management of the entity to manage the brand name and to measure activities that support the brand name, e.g. advertising and PR activities. E. Stability and geographical spread of the market in which the branded products are sold. F. Pattern of benefits that the brand name is expected to generate over time. G. Intention of the entity to use and promote the brand name over time, as evidenced perhaps by a business plan in which there will be substantial expenditure to promote the brand name.
Okay, thank you very much. Thank you very much. Now, let's try to wrap it up with disposal or requirements of an intangible asset. Now, there are two ways to which an intangible asset might be taken off our books, which is two ways of recognizing an intangible asset, similar to how we do for other assets. One is through outright disposal, and second one is when the intangible asset has achieved its useful life. We have to take it off the books, and resulting gain or loss will be reported in our profit or loss. For example, when it is disposed of, the carrying amount will be matched with the proceeds of disposal. When the proceed is in excess of the carrying amount, we report a gain in our profit or loss. Otherwise, when the proceeds fall short of the carrying amount, we report the loss as an expense in our profit or loss. Similarly, when an intangible asset is retired, the remaining value is written off as a loss in our profit or loss. And that is very simple from the perspective of the standard. And that's why the standard gives some clarification to say an intangible asset should be eliminated from the statement of financial position when it is disposed of or when there is no further expected economic benefit from its future use. On the disposal, the gain or loss arising from the difference between the net disposal proceeds and the carrying amount of the asset should be taken to profit or loss as a gain or loss on disposal that is treated as either an income or an expense. Does that make it clear? This is not different from what we know even within the principle of IAS 16 and similar to the principle of IAS 40 on investment property. Does that make sense to us?
Yes, sir.
Okay, any questions so far on this aspect? As our concluding aspect will now be on goodwill. But goodwill has been what we have been discussing extensively before now with respect to IFRS 3, business combination. We only reiterate most of what we have discussed earlier. And if you want to more or less have better understanding of it again, you revert to our videos on business combination and group accounts. Any questions so far? Any questions so far?
Yeah, no question from here, from my side.
Okay, now we are going to discuss on goodwill, looking at it from the perspective of business combination. Okay, we'll marry our perspective of IFRS 3 with our perspective of IAS 38. Now, as you all know, that goodwill we are talking about here is a purchase goodwill. And we are talking about a goodwill that arose from business combination. Okay? And we are looking at it from the perspective of goodwill that was acquired along with the business assets and liabilities. And as you all know, that goodwill from a practical perspective represents a commercial advantage a business has over its competitors, so that it's that value that has been paid for by the new investor in order to take control of that business. And therefore, goodwill by way of consideration or qualitative description is by way of creation based on the relationship, loyalty, and other things that has been created between the business and its customers. Now, goodwill is actually priced during the period of negotiation between the investor and the investee, okay? And in that situation, what happened is that there are different mechanisms in the finance world to which goodwill is valued, okay? But for accounting purposes, what amount of goodwill that is recognized is actually the excess purchase consideration over the fair value of the identifiable net asset acquired. And in that situation, that is the amount that we recognize as an accountant. But there are other things that goes on within the negotiation that is more or less taken into consideration in pricing and determining the appropriate amount to which goodwill can be paid for. Okay, both parties will quantify what is considered to be the amount of goodwill inherent in a business to which you want to pay for. And the reason why such a purchase goodwill is recognized is the advantage it has over internally generated goodwill, or because at this point there have been a validation of the value or cost of that goodwill by what is found to be the consideration that has been offered by the investor to the investee for the amount of that goodwill. And in that case, such goodwill will be recognized as an intangible asset as opposed to non-purchase goodwill, which is not recognized as an intangible asset. Now, since all of the conditions incidental other than separable criterion is met, goodwill will be recognized as an intangible asset. But because it doesn't meet separable criterion, goodwill in most cases will be identified separately from other intangible assets. And that is the requirement of the standard, which means at every point in time, goodwill must be shown separate from other intangible assets. Okay, and goodwill is paid for on the perspective of the synergy and some other attribution that is expected from it based on the acquisition of a new business. Now, the question then is, the goodwill in the account will be carried at cost upon initial recognition, and subsequently it will continue to be carried at cost subject to impairment. Why is it not amortized? It's not amortized on the premise that it does not have a finite life. Rather, it has an indefinite life. Its life is indeterminate, or because no one can, with some degree of certainty or reasonableness, to say this goodwill can last this organization for the next 10 years, or for 20 years, or for 5 years. Therefore, there is no practical basis of doing that. And that's why goodwill by nature has an indefinite life. And in that situation, it cannot be amortized because useful life is instrumental to amortization. And therefore, what happens to goodwill at every point in time is that at every reporting date, you must subject goodwill to impairment test. And any amount of impairment loss charged against goodwill will be used to reduce the amount of goodwill and also charge as an expense in the profit or loss. Okay, but again, subsequent improvement in the condition of the acquired business will not result in the reversal of the impairment of goodwill, because such reversal will be instrumental to creating internally generated goodwill and tends to recognizing it as an intangible asset, which is forbidden by the provision of IAS 38 that internal process of creating a goodwill should not be recognized, or because the cost of doing so cannot be validly measured or reliably ascertained. Now, I want somebody to take us through this journey of the position of IAS 38, which was in tandem, or which is in tandem with the requirement of IFRS 3. Over to you guys.
Okay, goodwill, IFRS 3 business combination. Purchased goodwill arising on consolidation is retained in a statement of financial position as an intangible asset under IFRS 3. It must then be reviewed annually for impairment. What is goodwill? Goodwill is created by good relationships between a business and its customers. One, by building up a reputation by word of mouth, perhaps, for high quality products or high standards of service. Two, by responding promptly and helpfully to queries and complaints from customers. Three, through the personality of the staff and their attitudes to customers. The value of goodwill to a business might be considerable. However, goodwill is not usually valued in the financial statements of a business at all. And we should not normally expect to find an amount for goodwill in a statement of financial position. For example, the friendly welcome given by cafe staff may contribute more to the cafe's profit than the fact that a new electronic cash register has recently been acquired. Even so, whereas the cash register will be recorded in the financial statements as a non-current asset, the value of a staff would be ignored for accounting purposes. On reflection, we might agree that this omission of goodwill from the financial statements of a business. A, the goodwill is inherent in the business, but it has not been paid for, and it does not have an objective value. We can guess at what such goodwill is worth, but such guesswork would be a matter of individual opinion and not based on hard facts. B, goodwill changes from day to day. One act of bad customer relations might damage goodwill, and one act of good relations might improve it. Staff with a favorable personality might retire or leave to find another job, to be replaced by staff who need time to find their feet in the job, etc. Since goodwill is continually changing in value, it cannot realistically be recorded in the financial statements of the business.
In addition, now let's now look at the goodwill that you can recognize, other than the one we cannot recognize, which is the purchased goodwill.
Purchased goodwill. There is one exception to the general rule that goodwill has no objective valuation. This is when a business is sold. People wishing to set up in business have a choice of how to do it. They can either buy their own long-term assets and inventory and set up their business from scratch, or they can buy up an existing business from a proprietor willing to sell it. When a buyer purchases an existing business, he will have to purchase not only its long-term assets and inventory, and perhaps take over its accounts payable and receivable too, but also the goodwill of the business. Purchased goodwill is shown in the statement of financial position because it has been paid for. It has no tangible substance, and so it is an intangible non-current asset.
Okay, thank you. Now, the next hurdle is, how do we value purchased goodwill? Okay, or how is the value of purchased goodwill decided? Now, this is decided based on financing terms or financial terms, okay, between the buyer and the seller. Most times when you are to purchase a business, there's always a continuum to which the price ranges, the lower band, the upper band, okay? If you look at in finance world today, you have comparable transaction basis, you have comparable price basis, you have discounted cash flow basis, and some other things like that, in which goodwill can also be priced. Some people use superannuation profit and all sorts of things. But we are not much more interested in that, because what we are interested in is what has not been the bargaining agreement or price that has been agreed to pay for goodwill in excess of the value of the tangible and intangible assets and liabilities acquired and assumed other than goodwill in this business combination. But what is much more critical to us as an accountant in this level is that we need to understand the price that has been paid for goodwill is the cost of that goodwill, which is supposed to be recognized upon initial recognition, which is at the point of acquisition of that business. Now, let's look at it. What does the standard provide as explanation or basis to which goodwill is valued in consideration between two parties, the buyer and the seller of a new business?
Okay, how is the value of purchased goodwill decided? When a business is sold, there is likely to be some purchased goodwill in the selling price. But how is the amount of this purchased goodwill decided? This is not really a problem for accountants who must simply record the goodwill in the financial statement of the new business. The value of the goodwill is a matter for the purchaser and seller to agree upon in fixing the purchase or sale price. However, two methods of valuation are worth mentioning here. A, the seller and buyer agree on a price for the business without specifically quantifying the goodwill. The purchased goodwill will then be the difference between the price agreed and the value of the identifiable net assets in the books of the new business. B, however, the calculation of goodwill often precedes the fixing of purchase price and becomes a central element of negotiation. There are many ways of arriving at a value for goodwill, and most of them are related to the profit record of the business in question. No matter how goodwill is calculated within the total agreed purchase price, the goodwill shown by the purchaser in his accounts will be the difference between the purchase consideration and his own valuation of the net asset acquired. If A values his net assets at $40,000, goodwill is agreed at $21,000, and B agrees to pay $61,000 for the business, but values the net assets at only $38,000. Then the goodwill in B's books will be $61,000 minus $38,000, which is equals to $23,000.
Okay, thank you very much. Okay, you will see that our emphasis here is that no matter the basis to which they've determined the value, what matters to us is what is the actual price paid for that goodwill, which will constitute the cost of the goodwill. Okay, now let's now look at it. To reiterate some of those things we discussed as principle under IFRS 3, business combination. What is goodwill from the perspective of business combination? How is that goodwill recognized? Will it be subjected to impairment, or will be subjected to impairment and amortization, if any? What if we have a negative goodwill? How is that recognized? What conclusion do we do? Do we carry out a reassessment before reaching a conclusion that actually this negative goodwill should have resulted in a gain arising from a bargain purchase? What and what do we need to do? When there's an impairment of goodwill, how should it be recognized? What if condition improve? Can we reverse impairment loss on goodwill? This is what we'll be looking at in this next phase. Over to you guys.
Okay, business combinations. IFRS 3 covers the accounting treatment of goodwill acquired in a business combination. Goodwill, an asset representing the future economic benefits arising from other assets acquired in a business combination that are not capable of being individually identified and separately recognized. That's IFRS 3, Appendix A. Goodwill acquired in a business combination is recognized as an asset and is initially measured at cost. Cost is the excess of the cost of the combination over the combination over the acquirer's interest in the net fair value of the acquiree's identifiable assets, liabilities, and contingent liabilities. After initial recognition, goodwill acquired in a business combination is measured at cost, less any accumulated impairment losses. It is not amortized. Instead, it is tested for impairment at least annually in accordance with IAS 36. A gain on a bargain purchase, also known as negative goodwill, arises when the acquirer's interest in the net fair value of the acquiree's identifiable assets, liabilities, and contingent liabilities exceeds the cost of the business combination. A gain on a bargain purchase can arise because the entity has genuinely obtained a bargain, perhaps, for example, because the seller has been forced to sell at a low price. However, it can also arise as a result of errors in measuring the fair value of either the cost of the combination or the acquiree's identifiable net assets. Before recognizing a gain on bargain purchase, an entity should first reassess the amounts at which it has measured both the cost of the combination and the acquiree's identifiable net assets, IFRS 3 paragraph 36. This exercise should identify any error. Any gain on the bargain purchase remaining should be recognized immediately in profit or loss.
Okay. Was this different from what we discussed with respect to group accounts when we were discussing that?
No, it's the same.
Really different from what we discussed at that point?
No, there's no difference at all.
Okay, now let's look at this question to give us guidance. What are the main characteristics or attributes of goodwill which distinguish it from other intangible non-current assets? Remember, I said we have to disclose goodwill separately from other intangible assets. Therefore, what is the uniqueness between goodwill and others as an intangible asset? And to what extent do you consider these characteristics should affect the accounting treatment of goodwill? If you have any reason or set of reasons, state such. Anyone to volunteer in this discussion?
Okay.
Enaru, Nuruddin, Bashir, Afar.
Goodwill, another intangible asset. I think the goodwill, one of the characteristics is that goodwill is acquired during business combination. That is one thing I've noticed, the characteristics of goodwill vis-a-vis intangible assets. So you acquire goodwill during a business combination. You basically then goodwill. If I think that's what I've seen that, because That's what I've seen for now.
Okay. Mr. Bashir. Okay, who else can make contribution before we look at what makes Goodwill unique from other intangible assets?
Okay, I just want to give you a try. The thing I see as a distinguishing factor there is even though we can also have other intangible assets with indefinite life, such as, I mean, you know, there are other intangible assets that also have indefinite life. But what I see is that Goodwill could be a little bit notional in the sense that it is coming from the the staff or the staff of that organization, which you cannot really put a specific definite life on. For instance, now, maybe the characteristics of a staff as to the way he handles his job or as to the way he handles his customer. You know, as we read earlier, these things can change. It is not stable. We cannot really place a particular, we cannot be certain about the value of Goodwill over a particular time, in the sense that it could fluctuate. Staff could be retrenched, staff could leave the organization, a lot of things could come in place that will affect the actual value of that Goodwill. So this is why it's a little bit different from other intangible assets with indefinite life.
Okay, thank you very much. Okay, now, Goodwill differ in substance from other intangible assets, starting from issue of not meeting the separable criteria, because Goodwill cannot be separated from the business as a whole or other assets, and which means you can't sell it separately, you can't buy it separately, and all sorts of things. Neither can you transfer it separately. And also, reliably measuring the value of Goodwill is a daunting task. It's highly unpredictable. Okay, the only time we're able to put a value to it is if somebody is willing to accept the value and pay for it, which is the purchase Goodwill recognized. And again, by nature of it, the value arises from various factors, such as employees' involvement, as you have explained, being highly positioned due to your location, being favored by government policy, and some other things over time, and some other things that may affect it. But indirectly, this cannot be extensively valued or put monetary value on top. And the value of Goodwill fluctuates from time to time. At some point in time, your Goodwill might be rising, sometimes it falls, sometimes it rises. Let's look at football teams. At some time, Manchester United was reigning. In the last 5 years, they barely win competitions, and probably in the near future, they go up again. And you know, it's oscillating. And in that case, it's highly difficult to predict. And also, the value of Goodwill is highly, highly subjective. Okay, because it's something that cannot easily be validated or verified. And that has been the argument over time that has been placed on issues that separate Goodwill from other intangible assets. And that's why the standard make it clear that at every point in time, you must disclose the amount of Goodwill either on the surface of the account, which is in the balance sheet, or in the notes to the financial statement. The value of Goodwill must be shown separately from the value of other intangible assets. Okay, any question on that? Now, can you read out the suggested solution to that to corroborate my explanation? Thereafter, we'll move to discussing the disclosure requirement of the standard.
Goodwill can be distinguished from, Goodwill may be distinguished from other intangible non-current assets by reference to the following characteristics. A, it is incapable of realization separately from the business as a whole. Able or predictable relationship to any cost which may have been incurred. Its value arises from various intangible factors such as skilled employees, effective advertising, or a strategic location. These indirect factors cannot be valued. The value of goodwill may fluctuate widely according to internal and external circumstances over relatively short periods of time. The assessment of the value of goodwill is highly subjective. It could be argued that because goodwill is so different from other intangible non-current assets, it does not make sense to account for it in the same way. Thus, the capitalization and amortization treatment would not be acceptable. Furthermore, because goodwill is difficult to value, any valuation may be misleading, and it is best eliminated from the statement of financial position altogether. However, there are strong arguments for treating it like any other intangible non-current asset. This issue remains controversial.
Okay, thank you very much. Now we'll go to more interesting discussion before we wrap it up with the disclosure requirements. And I want to put a question to you before you put it to me, because you've put it to me one of those days in the past. And the question borders on what you'll be seeing now. I'll show you financial report of some of these English clubs. Manchester City, Manchester United, Arsenal, Liverpool, and the likes. Now the question is this: imagine the football players that were signed up for $100 million, 50 million, 30 million, 40 million, and etc. How do they account for this sign up? Are they doing much more of human resource accounting or human capital accounting? Are they now bringing the value of individuals, that is human being, into the balance sheet of each of these clubs? And likewise, why can't my own organization also place value on me as a valuable individual within the organization, where I can be reflected on the balance sheet of the company? Now, can anybody give a narrative towards this? How do you expect, what category, if they are to recognize the value of sign-off and all sorts of things in the balance sheet, that means you are saying that it's an asset. What form of asset will it be? Okay. Is it tangible? Is it intangible? What tangible? What type of intangible? And what do you do to it over time? Yeah.
Yes, I think from what we have discussed so far, it has dawned on me that when clubs sign players, the signing fees is capitalized as an intangible asset. I don't see it as a goodwill, maybe wrong, but that signing fee is capitalized and amortized during the period, throughout the period of the players, the period stipulated in the contract. That is the way I see it. So basically, that period, that player is the costs of signing that player is capitalized. So it's not basically the player that is capitalized, not the player, but the amount that is used to purchase that player. That is the way I see it. Based on what we've discussed so far.
I can see you trying to shape in certain narrative, whether it's the player or the right or anything. What do you classify it as? First is an asset, okay? Well, what form of asset will it be?
I say it's an intangible asset.
It's an intangible asset, okay? What is an intangible asset now? Is it the player itself or the right over the player or what?
No, that's why I said the right over the player for that period. So it is, so the cost can be reliably measured because there is a cost of signing that player. So basically the problem of reliable measurement does not occur. in that in this case.
You know, we have about 3 options to which we can group it. Is it a tangible asset which falls under property, plant, and equipment? Is it an intangible asset which may fall under one of those types of intangible asset or rights? Or is it right of use of assets which falls under IFRS 16 leases? Which of them? Does it fall under IAS 38, IAS 16, IAS 40 investment property, or
no? I think it falls.
It is,
I think it falls. No, it cannot fall under leases. It cannot fall under leases because in that case, if it falls under leases, that means you have to begin to talk about depreciating that lease or that object of lease. So I don't think depreciation will come in here. What can really come is amortization over the useful life. So I think it's to fall under IAS 38. That is why I say it.
Any other view?
Okay, I think I share the view of Enauro. And if I can remember properly, I think anything that has to do with intangible assets are scoped out of IFRS 16. And also, I agree to the fact that because of the contract between the company and possibly the player or its manager, that creates, a right, an enforceable right for that matter, to control the usage of, the underlying asset over the period of the contract. So in that regards, they're satisfied, one of the criteria for recognition of intangible assets. And also, it can be identified separately, and it can be sold separately, because today the club might decide that no, we no longer need this player because we have an alternative for him. They can sell him, they can loan him to another football club. So also the issue of future economic benefits being accruing to the organization has also been satisfied, because over the period of its contract, the organization or the football club will continue to get revenue, or will continue to get benefit from his actions. So I believe it should be classified as intangible assets under IAS 38, because it is not as if it is that player himself that is being capitalized, but it is the value that is associated with the contracts that is being capitalized in this situation.
Okay, which means from what we are seeing here, it's not tangible assets, even though I can see it somehow which it's not right of use assets, and it's not other form of investment or investment property. Okay, we'll check it. We'll look at our notes and see what it constitutes. Okay, and similarly, let's look at Man U. Man U has property, plant, and equipment, right of use assets, investment properties, intangible assets, and others. Let's look at Liverpool. Liverpool has intangible assets, tangible assets, stock, and etc. Let's look at almighty Arsenal. Arsenal has both the company and the group, tangible assets, intangible assets, investment, and the likes. Okay, now let's come back here. Okay, let's look at the note 11 for the intangible assets. Okay, let's see the breakdown of it. Note 11 only gives us the cost structure, the additions, the disposal, amortization, and etc. But let's go to the accounting policies. The accounting policy should provide us more guidance. Okay. This is the section for the accounting policy. Okay, I'll look at the policy over intangible assets, probably to give us more clue. Now, can somebody read this policy over this intangible assets here? Let me enlarge this. Okay. Can somebody read it out?
Okay, intangible assets. Intangible assets acquired separately and measured on initial recognition at cost. The cost of intangible assets acquired in a business combination is their fair value as at the date of acquisition. Following initial recognition, intangible assets are carried at cost, less accumulated amortization and accumulated impairment losses, if any. The useful life of intangible assets are assessed as either finite or indefinite. Intangible assets with finite lives are amortized over their useful economic lives and assessed for impairment whenever there is an indication that the intangible asset may be impaired. The amortization period and the amortization method for an intangible asset with a finite useful life are reviewed at least at the end of each reporting period. Changes in the expected useful life of the expected pattern of consumption of future economic benefits embodied in the assets is accounted for by changing the amortization period or method as appropriate and are treated as changes in accounting estimates. The amortization expense on intangible assets with finite lives is recognized in profit or loss in the expense category consistent with the function of the intangible assets. Intangible assets with indefinite useful life are not amortized, but are tested for impairment annually, either individually or at the CGU, cash generating unit level. The assessment of indefinite life is reviewed annually to determine whether the indefinite life continues to be supported or to be supportable. If not, the change in useful life for indefinite to finite is made on a prospective basis. Gains or losses arising from the recognition of an intangible asset are measured as a difference between the net disposal proceeds and the carrying amount of the assets and are recognized in profit or loss when the asset is derecognized.
And let's now look at the areas that affect the players.
Players' registrations and football staff remuneration. Initial recognition. Players' registrations costs, including transfer fees, associated agent fees, Premier League levy fees, and other directly attributable costs are initially recognized at the fair value of the consideration payable for the acquisition. When a player's registration is acquired, management will make an assessment to estimate the likely outcome of a specific performance conditions. Contingent consideration will be recognized in the player's registration costs when management believes the performance conditions are met in line with the contractual terms. Periodic reassessments of the contingent registration are completed. Any contingent amounts that management believe will be payable are included in the player's registrations from the date management believe the performance conditions are met. Any additional amounts of contingent consideration not included in the costs of players' registrations are disclosed separately as a commitment. Amortization of cost is on a straight line basis over the length of the player's contract.
Okay. I think that is clear to us. That is clear to us. Okay. That is the area I wanted us to look at. And when you check it for Man U, it's in similar fashion, Liverpool and Arsenal. Therefore, you could see how each club accounts for the players' rights or the contractual right over the use of players by football clubs. Okay. Now let's now shift towards our final discussion about disclosure. Okay, what are you expected to disclose in a situation where you have an intangible assets in a reporting period? Now let's look at the general disclosure requirements and we'll wrap it up from that perspective. Okay.
You want me to read?
Yes. General disclosure.
General disclosure. An entity shall disclose the following for each class of intangible assets, distinguishing between internally generated intangible assets and other intangible assets. A, whether the useful life are indefinite or finite, and if finite, the useful lives of the amortization rate used. B, the amortization method used for intangible assets with finite useful lives. C, the gross carrying amount of any accumulated amortization aggregated with accumulated impairment losses at the beginning and end of the period. D, the line items of the statement of comprehensive income in which any amortization of intangible assets is included. E, a reconciliation of the carrying amount at the beginning and end of the period showing 1, additions indicating separately those from internal development, those acquired separately, and those acquired through business combinations. 2, assets classified as Z for sale or included in a disposal group classified as Z for sale in accordance with IFRS 5 and other disposals. 3, increases or decreases during the period resulting from revaluations under paragraph 75, 85, and 86, and from impairment losses recognized or reversed in other comprehensive income in accordance with IAS 86, if any. 4, impairment losses recognized in profit or loss during the period in accordance with IAS 86, if any. 5, impairment losses reversed in profit or loss during the period in accordance with IAS 86, if any. 6, any amortization recognized during the period. 7, net exchange differences arising on the translation of the financial statements into the presentation currency and on the translation of a foreign operation into the presentation currency of the entity. And 8, other changes in the carrying amount during the period.
Thank you very much. Now, this brings us to the end of the extensive discussion on how do we account by way of recognition, measurement, and disclosures of intangible assets, including goodwill. Any other question before we wrap it up and call it the end of this section? Okay, in the absence of none, thank you very much and God bless you for this section. Good night.
Thank you, sir. And good night. God bless you.